All right, guys, we're back here with another book review, book report. This is again for you guys who want to read the books, but maybe don't have time. You can use me as your cliff notes for the book. I'm going to be reading the book. I'm going to be sharing with you my takeaways, my leverageables, what I got out of the book. So all the gems, I'm going to give you guys all the gems from the book because I read the book. And I'm doing this for you so it'll make your trading journey easier, faster, smoother, without you having to read all of this pages of information. So I'm going to distill it down for you so you can just move forward with your trading journey. Now, the book we have here today is Quantitative Finance for Physicists, an Introduction by Anatoly B. Schmidt. All right, so let's get into it. Get right into it. Hop into here. So this book is really dealing with, let's see here, a couple different sections: financial markets, probability distribution, stochastic processes, time series analysis, fractals, nonlinear dynamical systems, scaling in financial time series, option pricing, portfolio management, market risk measurement, agent-based modeling of financial markets. Okay, so this is mainly for those people who are physicists and who want to work on Wall Street but haven't read anything about finance. The book is written by a physicist himself. It contains two parts, the applied part and the academic part. Two major fields, econometrics and mathematical finance, constitute the applied part. Econometrics is defined as the methods of model-based statistical inference in financial economics. Mathematical finance implies finance has given rise to several new mathematical theories, including portfolio theory, option pricing theory, and risk management. It does say physicists are the primary audience for the book. However, computer science and mathematics majors who are willing to work in the finance industry, as well as majors in economics and finance who are curious about econophysics and agent-based modeling of financial markets. All right. Let's see. It's got some notations for the scalar values. All right. The efficient market hypothesis is mentioned, as well as arbitrage. It says many different financial assets, stocks, bonds, currencies, options, and others are traded around the world on the New York Stock Exchange, over-the-counter markets. There are also financial data services such as Bloomberg and Reuters. Modern electronic networks facilitate access to huge volumes of market data in real time. Usually there's a spread between the highest bid and the best, lowest asking prices, which provides profits for the market makers. Some traders submit market orders. They buy at the current best ask prices and sell at the current best bid prices. Some traders submit limit orders. Limit order reflects the trader expectations of future price movement. There are also stop orders designated to limit possible losses. Holding assets, particularly holding derivatives, is called a long position. The opposite of long buying is short selling, which means selling assets that the trader does not own after borrowing them from the broker. Limit orders and stop orders form the market microstructure. Market liquidity is used to describe price sensitivity to market orders. Low liquidity means that the number of securities available at the best price is smaller than a typical market order. In that case, it's executed within a range of available prices rather than at a single best price. Okay, returns and dividends. And goes into some computations, logarithmic computations for quantitative analysis. Price is equal to logarithm P. Price is equal to log P. P is equal to log multiplied by P. A return is a measurement of investment efficiency. More equations. More equations for the continuously compounded return or log return. Dividend effects. Dividends play a critical role in the discounted cash flow or present value pricing model. Calculating the present value via the future value is called discounting. It gives the calculation for that. It typically deals with zero coupon bonds sold at their present value promise a single payment of their future value at maturity date. More equations. Value of R that may attract investors is called the required rate of return. R must be greater than G. G is necessarily, what is G? Dividend growth rate. The rational bubble. The bubble is unbounded growth. The bubble is rational since it is based on rational expectations of future returns. It describes the Blanchard-Watson model. Market events have a discrete nature and price variations cannot be smaller than certain values. Let's see, market efficiency, arbitrage. Asset prices generally obey the law of one price, which says that prices of equivalent assets in competitive markets must be the same. A violation of the law of one price leads to arbitrage, which means buying an asset and immediately selling it, usually in another market with profit and without risk. Typically, this happens in the case of prescription drugs in the USA, Europe, and Canada. Another example is the so-called triangle foreign exchange arbitrage, typically dealing with situations such as the US dollar, the euro, and the yen. Arbitrage opportunities persist due to unresolved, the arbitrage with prescription drugs persists due to unresolved legal problems. However, generally, the arbitrage opportunities do not exist for long. Arbitrage may appear from time to time. Foreign exchange traders do make a living in part by finding such opportunities. They rush to exchange. There's only a finite number of assets at the best price. As noted previously, as soon as they are all taken, the exchange rate falls to the equilibrium value and the arbitrage vanishes. In general, when arbitrageurs take profit, they act in a way that eliminates arbitrage opportunities. Efficient market hypothesis is closely related to the absence of arbitrage. It's the idea of a market without arbitrage, but it's much more than that. The share price of a company may change due to its new earnings report, new prognosis of the company performance, or due to a new outlook for the industry trend. Macroeconomic and political events, or simply gossip about a company's management, can also affect the stock prices. All these events that imply that new information becomes available to market. Efficient market theory states that financial markets are efficient because they instantly reflect all new relevant information in asset prices. Efficient market hypothesis proposes the way to evaluate the market efficiency. For example, an investor in an efficient market should not expect earnings above the market return while using technical analysis or fundamental analysis. Two notions are important for efficient market hypothesis. The random walk notion. Another notion is rational investors. Random walk is market prices follow the random walk if their variations are random and independent. Rational investors who immediately incorporate new information into fair prices. Talks about Batchelor's pioneering work on random price back in 1900. Formal definition by Fama in 1965. Statistical analysis by Lowe and McKinley in the late 1980s. Let's see what else. Several investment firms implement statistical arbitrage trading strategies based on the market inefficiencies that were revealed in earlier research. Let's see. Behavioral finance. Irrational human behavior was described by Kahneman and Tversky. This is important. First participants were with $1,000 were given a choice between A, gambling with a 50% chance of gaining $1,000 and a 50% chance of gaining nothing, or B, a sure gain of $500. In the second situation, participants with $2,000 were given a choice between a 50% chance of losing $1,000 and a 50% chance of losing nothing, and B, a sure loss of $500. Thus, the option B in both situations guaranteed a gain of $1,500. Yet the majority of participants chose option B in the first situation and option A in the second situation. Hence, participants preferred sure yet smaller gains, but were willing to gamble in order to avoid sure loss. Keynes' explanation that animal spirits govern investor behavior is perhaps an exaggeration. Yet investors cannot be reduced to completely rational machines either. Actions of different investors, while seemingly rational, may significantly vary. May be caused by different perceptions of market events and trends, heterogeneous beliefs. Different investors have different resources for acquiring and processing new information. As a result, the notion of so-called bounded rationality has become popular in modern economic literature. The search of ideas yielding excess returns never ends. Let's see here. It's got some more mathematics exercises, probability distributions, basic notions of mathematical statistics, form the framework for analysis of financial data. Probability density function that defines the probability to find X between A and B. Must be non-negative function and must satisfy the normalization condition. More probability equations. Let's see, variance and the standard deviation are the conventional estimates of the deviations from the mean values of X. Conditional expectations, volatility, standard price deviation of prices used to characterize the price volatility. Talks about some leptokurtosis, joint distribution. Let's see what else they got in here. Important distributions, more equations. Gaussian distribution, Poisson distribution. Central limit theorem. Cauchy distribution. Fisher-Tippett theorem. Gumbel distribution. Fresher distribution. Pareto distribution. Weibull distribution. Weibull distribution has a finite tail. Stable distribution is scale invariance. Levy distributions, more equations, references for further reading. Stochastic processes, It is used to describe behavior. Specifically, the Werner process or the Brownian motion plays a central role in mathematical finance. Markov process, Chapman, Kolmogorov equation, Fokker-Planck equation, Wiener process. Yep. The Brownian motion is derived using Langevins equations and discrete random walk. Markov process. Let's see. More equations. Brownian motion is used for describing generic stochastic processes. Brown's observation of random motion of pollen in water. More equations. Martingales is a stochastic process that satisfies the following condition. It plays an important role in the modern theory of finance, and then follows an equation. Rooted in the gambling theory is the notion of martingale, closely associated with the notion of fair game, in which none of the players has an advantage. Implies that the expectation of the gamer wealth at time t+1, conditioned on the entire history of the game, is equal to the gamer wealth at time t. Similarly, this equation means that the expectation to win at every round of the game being conditioned on the history of the game equals 0. In other words, martingale has no trend. A process that has a positive trend is named sub-martingale. A process with negative trend is called super-martingale. Future reading. Time series analysis. Time series analysis has become an indispensable theoretical tool in financial and economic research. Commonly used univariate, autoregressive, and moving average models. Process with non-stationary variance. Autoregressive models. Time series, trends and seasonality. Presence of trend implies that the time series has no mean reversion. Time series with trend is named non-stationary. If a process is stationary, it means variance, and autocovariance are finite and do not depend on time. It is important to discern deterministic trend and stochastic trend. Conditional heteroscedasticity. More equations. Multivariate time series. Multivariate models yield not only new implementation problems, but also some methodological difficulties. One should be cautious with simple regression models. Let's see. Simultaneous equation. Data snooping. Vector autoregressive model. Let's see here. Fractals are geometric objects that are constructed by repeating geometric patterns at a smaller and smaller scale. Fractal theory is a beautiful theory that describes beautiful objects. Greatly influenced by Mandelbrot. Self-similarity is the defining property of fractals. Shape transformation along all coordinate axes are the same. Geometric patterns are isotropic. Self-affine. The difference between self-similarity and self-affinity is obvious for geometric regions. It's obvious for geometric objects. However, only self-affinity is relevant for the graphs of financial time series. Indeed, since time and prices are measured with different units, their scaling factors cannot be compared. Self-affine is if the geometric patterns are not isotropic. There's deterministic and stochastic fractals with the same fractal dimension. Their fractal dimensions, random fractals. Hurst exponent. Multifractals. More equations for algorithms for fractals. Nonlinear dynamical systems. Strange attractor. Strange attractor. Price dynamics can be attributed in part to the complexity of financial markets. Prices may be partly forecastable. Research of chaos in finance and economics is accompanied with discussion of limited predictability of the processes under investigation. Discrete systems, the logistic map. More graphs, continuous systems. Autonomous systems does not depend explicitly on time. A non-autonomous system can be transformed into an autonomous one by treating time in the function of f multiplied by xt as an additional variable and adding another equation to the flow. You can increase the dimension of space by 1. Chaos is usually associated with dissipative systems. Systems without energy dissipation are called conservative or Hamiltonian systems. Limit cycles. Van der Pol equations change qualitatively from the point attractor to the limit cycle. Bifurcations lead to the limit cycle are named the Hopf bifurcations. Toroidal trajectories, Lorentz model. Pathways to chaos, local bifurcations, global bifurcations. Local occur in some parameter range, but the trajectories become chaotic when the system control parameter reaches the critical value. 3 types of local bifurcations are discerned: period doubling, quasi-periodicity, and intermittency. Period doubling starts with the limit cycle at some value of the system control parameter with further change. Process proposed by Landau. Frequency spectrums, quasi-periodicity by rule and takens. Intermittency is a broad category itself. Chaotic transients, measuring chaos. It is important to understand whether randomness of an empirical time series is caused by noise or by the chaotic nature of the underlying deterministic process. References, scaling in financial time series. No model exists for the stochastic process describing the time evolution of the logarithm of price that is accepted by all researchers. There are several reasons for that status quo. Okay, and then foreign exchange rates are another object frequently used in empirical research. Power laws and financial data. Returns in the S&P 500 were studied for the periods. Nikkei index, Hang Seng index. Observations, number of trades. The Lotka-Volterra system equation is given. New developments. More equations. Resources, options, pricing. Binomial trees are used. Classic Black-Scholes theory for the option pricing theory. Financial derivatives are instruments whose price depends on the value of another underlying asset. There's the forward contract, and then there's the long position and the short position. Futures contracts are the forward contracts that are traded on organized exchanges such as the Chicago Board of Trade and the Chicago Mercantile Exchange. Options give an option holder the right to trade an underlying asset rather than the obligation to do this. Particular call options gives its holder the right to buy the underlying asset at a specific price, so-called exercise price or strike price, by a certain date, expiration date, or maturity. The put option gives its holder the right to sell the underlying asset at a strike price by an expiration date. Two basic option types are the European options and the American options. The European options can be exercised only on the expiration date, while the American options can be exercised any time up to the expiration date. Most of the current trading options are American. General properties of stock options: current stock price, strike price, time to maturity, stock price volatility, risk-free interest rate, dividends paid during the life of the option. Long call option, short call option. Long call option means that the investor buys the right to buy an underlying asset. Short call options means that the investor sells the right to buy an underlying asset. Long put option means that the investor buys the right to sell an underlying asset. Short put option means that the investor sells the right to sell an underlying asset. European call and put options with the same strike price satisfy the relation called put-call parity. Binomial trees for option pricing. Risk neutral valuation. Option pricing, Black-Scholes theory. Let's see here. Gamma. Yep, references, appendixes, exercises. Portfolio management. Portfolio selection is a real problem that has been turned into elegant mathematical theories. We have stocks, bonds, foreign currencies, real estate, antiques, and others. Let's see, treasury bills. Typically dealing with rate of return equations and portfolio standard deviations, capital asset pricing model, CAPM. CAPM is the equilibrium model and has no time dependence. However, econometric analysis based on this model can be conducted, providing that the statistical nature of returns is known. Arbitrage pricing theory. Let's see here. Arbitrage trading strategies. Simple investment strategy means buy and hold securities of good companies. A more sophisticated approach is sensitive to changing economic environment and an investor's risk tolerance. The strategy named pair trading involves simultaneously buying shares A and short selling shares B within the same industry of two companies. If the entire sector rises, this strategy does not bring as much money as simply buying shares A. However, if the entire market falls, presumably shares B will have higher losses than shares A. Then the profits from short selling shares B would more than compensate for the losses from buying shares A. Pair trading. Convertible arbitrage. Fixed income arbitrage. Mortgage-backed securities arbitrage. Merger arbitrage. Equity hedge. Equity market neutral strategy and statistical arbitrage. Relative value arbitrage. Yep. Market risk measurement. Liquidity risk, credit risk, operational risk. Operational risk is a generic notion for unforeseen human and technical problems such as fraud, accidents, and so on. Let's see here. More graphs and equations. More equations. Agent-based modeling of financial markets. The agents are traders, investors, does not fit well with the classical financial theory that is based on the notions of efficient markets and rational investors. It implies that traders' actions determine price. Minority game. Minority game is a simple binary choice problem in which players have to choose between two sides, and those on the minority side win. In the minority game, there's no communication among players and only a given set of forecasting strategies to find player decisions. Let's see here. Deals with the bar, stool, problem, non-equilibrium price models, more equations, the observable variables model, the framework, price-demand relations, more equations and graphs, birth of a liquid market, more equations and graphs, comments. This is an academic book written for physicists and mathematicians and for self-study. Different references, chapter 1. All right, guys, if you stuck around to the end, I know me reading it, it didn't feel like it was 30 minutes, but that's what it took. You know, the book is itself. How many pages is this? 160, 170 pages. So, you know, that's a, great book. It gave me some good information on the price splitting models, different arbitrage opportunities, what that means, how to look for those opportunities in the marketplace, how to capitalize on those opportunities. So again, if you guys have any books you want me to read, send them my way. I'll read them. I'll do a book review on them, and I'll put them on my page, on my channel, on my YouTube. So make sure you guys subscribe to that. I'm doing these books for you, so you don't have to read the book and look for the gems. I'm going to give you the gems from my reading of the book, because I'm going to read the book anyways to make my trading journey smoother, easier, more profitable, right? Because like they said in the beginning of the book, the ideas for better profits are never ending. The search for the ideas for better profits are never ending. So I'm doing this for you guys so you guys can take my time. I'm already doing the research. I'm already reading the books. It makes your trading journey easier. You get the gems. If maybe you want to decide to buy the book or read the book, however, you can use this as a Cliff Notes version of what you want to do before you end up spending all this time reading a book or reviewing a book or buying a book or however. So make sure just to leave a comment, share this with your friends if you found this valuable. If you have any feedback, let me know. And come back for the next book, because I'm going to be dropping these pretty regularly. So stay tuned for more. Farewell.